Okay, let's dive right into this explainer. Today, we are putting the Hartford through the ultimate stress test. We like to call it the legendary Guru Gauntlet. We're going to take this massive property and casualty insurer and basically interrogate its financials using the exact super strict frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, plus some rigorous mathematical modeling just to keep things completely honest.
Here is our roadmap for today. We'll do a quick company snapshot, look through the Buffett lens, the Lynch lens, the Graham lens, run a DCF and alternate valuations, and wrap it all up with a synthesis.
Section 1, the company snapshot for the Hartford Insurance Group. So the Hartford is this absolute titan of a property and casualty insurer sitting on a $38.9 billion market cap. But here is the real kicker, their golden goose, if you will. They have this highly lucrative exclusive licensing agreement with AARP. This contract gives them direct, unrivaled access to that massive 50-plus demographic, and they've got it locked down tight effectively through 2032. Talk about a massive competitive advantage.
And that brings us to our starting line today, the current share price of $143.61. Now, everything we do from this exact moment forward is about answering one simple question. Does that specific price tag represent a screaming bargain, a fair deal, or an overpriced premium based on the actual cold, hard cash this business generates?
Well, speaking of generating cash, their recent performance is just, wow. It's absolutely incredible. If you look at the Q1 26 data, their core earnings shot up a whopping 36% year over year, hitting $866 million. That's compared to $639 million back in Q1 of 2025. You really have to step back and ask, how is a mature legacy company like this still finding ways to expand its bottom line that aggressively?
Let's move on to Section 2 and see how Warren Buffett would view this.
You know the Oracle of Omaha, right? He is always hunting for wonderful companies at fair prices, and Buffett absolutely loves a wide economic moat. That exclusive AARP contract? Yeah, that is a textbook moat. It is a barrier to entry that competitors literally cannot cross. Now pair that moat with the jaw-dropping 20.3% core return on equity. Plus, he demands a conservative balance sheet, and with a highly manageable debt-to-equity ratio of just 0.23, the Hartford completely clears that hurdle. The earnings consistency we're seeing here is exactly the kind of stuff Berkshire Hathaway dreams about.
But Buffett doesn't stop there. He's obsessed with owner earnings, the actual usable cash a business pumps out for its owners. Now, the 10Q doesn't hand this to us on a silver platter, but we can definitely estimate those robust owner earnings based on their Q1 net income of $851 million. Annualize that, and you're looking at roughly $3.4 billion in net income. Add back those non-cash charges, back out capital expenditures, and boom, it is crystal clear HIG easily meets Buffett's stringent quality criteria. He would absolutely love the underlying business, but as always, he'd demand a strict margin of safety on the price.
All right, Section 3, shifting gears to the Peter Lynch lens.
So how would the legendary mutual fund manager categorize this giant? As a mature, massive insurance company, Lynch would definitely peg the Hartford as a reliable stalwart. Stalwarts are those big, established companies that, sure, they aren't going to double your money overnight, but they offer incredibly consistent earnings. Most importantly, they provide serious downside protection when the market gets turbulent. You buy these guys for stability and maybe a solid 10 to 12% annual return.
Now, the absolute vital metric for Lynch's framework is his all-time favorite valuation tool, the PEG ratio. He strongly believed a fairly priced company should have a price-to-earnings ratio that's roughly equal to its growth rate. So you simply divide the PE by the growth rate. A PEG of exactly 1.0 means it's fairly valued, and anything below that, well, that's a true bargain.
But here's where things get a little tricky for HIG. When we crunch the market data, we get a PEG ratio of 3.81. At 3.81, they're sitting way above Lynch's ideal 1.0 threshold. Even though their current PE of 9.28 is objectively quite low, the market is already pricing in the slower, long-term growth rate that's pretty typical for these giant insurers. Because that PEG is running so hot, it strongly suggests the stock might be fully valued right now relative to its long-term growth trajectory. So for Peter Lynch, this is going to be a hold.
Moving right along to Section 4, it's time for the Benjamin Graham lens.
First up, we have to run his famous defensive investor checklist, and honestly, the Hartford passes this with flying colors. We're talking massive scale at nearly $40 billion, a beautifully conservative balance sheet, super stable earnings, and a PE well below Graham's strict maximum threshold of 15 for defensive stocks. Check, check, and check.
But the ultimate gauntlet is Graham's actual intrinsic value formula. This is a very strict historical metric that blends earnings and book value. We take the annualized EPS of $12.32, multiply that by the book value per share of $67.50, multiply that result by his famous constant of 22.5, and finally take the square root of that whole entire equation.
And the math spits out a Graham intrinsic value of exactly $136.78. Now recall that our current price is $143.61. That means at today's price, Graham would actually sit on his hands and wait. He famously demanded a price significantly below that calculated intrinsic value just to guarantee his required margin of safety. It's an undeniably great company, but for a hardcore old-school value investor like Graham, it's currently trading at a slight premium to its actual hard asset and earnings value.
All right, Section 5. Let's look at the discounted cash flow and alternate valuations.
Since an SEC 10Q obviously doesn't include a neat little 10-year forward-looking forecast, we have to make some educated assumptions here. If we build a model with a conservative 2% terminal growth rate and apply an 8% weighted average cost of capital, which basically just represents the risk of the investment, our discounted cash flow fair value lands right around $150 per share. Now, if we tweak those numbers, say dropping the WACC to 7%, the value obviously goes up. But 150 is a really rock-solid, reasonable base case scenario based on their current cash generation.
We can also double-check that with a comparable company analysis. The Hartford is trading right now at a PE of 9.28. If we assume that HIG should actually trade closer to a more standard financial sector average PE of around 12, which makes total sense given its massive ROE and that AARP moat, its fair value bumps up to $147.84. So both our pure math DCF and our comps model are suggesting the stock is slightly undervalued at the moment.
Section 6. It is time for the master synthesis and our final verdict.
Blending all these different guru insights gives us a genuinely fascinating picture. IHIG is currently trading right around $143. Look at where that puts us. It literally sandwiches the current price perfectly between Graham's ultra-conservative floor of $136 and the DCF's slightly more optimistic ceiling of $150. It is effectively trading exactly in the dead center of its fair value range.
So what is the ultimate takeaway here? The incredible 20.3% core ROE and that locked-in ARP moat make it a fantastic, ultra-high-quality company. Warren Buffett would certainly give it a nod of approval. But those notoriously strict value guys like Lynch and Graham, they definitely balk at the current price, purely because it lacks a deep, undeniable discount. Because it's trading right near its intrinsic value, the final blended verdict for the Hartford at $143.61 is a very solid hold.
We've seen that the stock is a high-quality stalwart, basically trading right at its calculated fair value. Which leaves us with one final data-driven question for you to ponder today. Considering that incredibly robust moat, but acknowledging the lack of a deep, screaming discount, is that ultra-tight margin of safety wide enough to actually trigger a buy for your own portfolio? Or are you going to hold out and wait for the next market pullback?